Good morning, good evening, and good afternoon, everybody. Hope everybody's having a fantastic day. It is time for Trade the Fed with Garrett Baldwin and CJ. Let's start things out with Garrett Baldwin in 5, 4, 3, 2.
All right, everybody, welcome to the greatest show in the history of the world, and that is where we trade the Federal Reserve, because everyone gets excited when I talk about monetary policy. So here we are. It is June 14th. This is the fourth Fed meeting of the year, and everybody will tell you that it is by far the most important meeting of the year, right? Why is it the most important? Because, well, expectations are that the Federal Reserve is not going to do anything when it comes to the policy of their rates today. So we look at the current status of expectations. You're at 2.3%. Probability of of a rate hike at 25 basis points. Looks like we're going to stay at 5. Now, we've talked about this all week. The odds have precipitously dropped over the last couple of weeks. Back on June 7th, we were at about a 27% probability. We're still at about 15% back in May. Now, why does this matter? Well, nothing may happen today, but the focus will quickly and abruptly turn to the following meeting that's coming up in July. Expectations are for about a 60% probability of a rate hike for 25 basis points at the next meeting, and a possibility, about a 1.35% chance of a 50-point hike. Now, all of this, we're getting ahead of ourselves. I recognize that. We want to kind of look at the current status of the market, but I will state that the CPI number yesterday, the rate of inflation, not inflation, the rate of inflation dropped to 4%. Now, I know the White House and some other people like Chuck Schumer are saying that they've halved inflation. Those people have no idea how economics works, and they prove it every day by putting out ridiculous charts like the ones that they were putting out yesterday saying that they've halved inflation. We could, of course, if we wanted to, solve inflation pretty quickly if we did not run deficits, and we could, of course, just drop our interest rates lower. But because we run a $1.16 trillion deficit so far in the first 8 months, which is 191% higher than where we were last year, we're going to continue to see some level of inflation run through the system, and it will remain stagnant there. Now, the big question is how much more will inflation, the rate, drop this month? Some numbers are coming out suggesting that it may fall into the 3.2% area. And if that is the case, and we do not see any dramatic uptick, or we see this really continue to slow down in terms of the rate of inflation, that's where the narrative of this entire market will shift. The big question moving forward will not be how high will the Fed go, but how long until they make a move and cut interest rates. And that is why we will be watching the Fed report, the Fed minutes that will come out on July 5th, the day after Independence Day. Why is that relevant? Because we're looking to see how long it is that the voting members anticipate that we will keep rates at a specific level. And if we look out into next year, the first meeting for January of next year, which is late in the month, the expectation is that we're still going to be above 5%, the market pricing that in. First cut expectations start to show up around March of next year, if not May. But if the dot plot suggests that we will be higher for longer, remaining at that 5% rate, and then even all the way out to December of next year, where we're talking about a 3.5% to 4% level, the figures will dramatically shift for 2025 and possibly the long-term expectations. All of this is relevant to the market because, again, the bond market will be impacted by this. This also impacts the zombie stocks, the companies that have absolutely no profitability and massively high valuations. They will be facing some challenges moving forward as well if interest rates are elevated. All eyes on the tech sector. Now, I spent some time today talking to people with Flashpoint. I'm going to write about this tomorrow with postcards about why this market has behaved the way it has this year. My argument remains that it's not just about artificial intelligence. Effectively, the rate hikes that the Fed have created have wiped out the venture capital industry pretty significantly. Big article in the Wall Street Journal on the 9th talking about how companies in the venture capital space are unable to generate enough capital to keep moving. That is leading not only to the shutdown of a lot of startups, which are the future competition of big tech, but it's also leading to a lot of people being able to go back and work. They're taking advantage of the human capital. And there's a couple other elements where these companies, by their balance sheet practices, are able to effectively get interest-free loans through their vendors while every other startup is paying for cost of capital. I'll talk about this tomorrow. It's a very important subject because for the foreseeable future, those companies may remain very, very strong, particularly at an anti-competitive level moving forward. We want to keep an eye on this because the market is now so over leveraged in these big tech names, the companies that, as we have seen in the past, that 93% of the QQQ is now just something like 16% of the total market capitalization. In fact, Microsoft is effectively the same market capitalization on the Qs as the bottom 90 some stocks. And that is obvious, a significant amount of concentration moving forward. As we look at the 2 o'clock hour, again, expectation is there's not going to be any rate hike today. If they surprise, don't expect this market to remain elevated for too long. We are seeing some selling coming out of this morning. We've come off that top Bollinger Band. We've sold off down toward the second standard deviation band. And as we get into these last couple of minutes, the question will be, do we just kind of move back to equilibrium? Now, as we talk about the Fed, remember, when it comes to this market, barring no rate hike right now, there's probably going to be a little bit of chop. But for the first 30 minutes, our focus is not really built around trying to trade 2 o'clock to 2:30. You're going to see a period right now where you're going to see whatever is left out of this percentage, that 2.3% that we were talking about, that's going to effectively be sucked out of the scenario. They will announce it at 2 o'clock, and then Jerome Powell will speak at 2:30. What we have seen historically is at 2:35 to 2:37, the market likes to take a position, and it typically moves between that two-minute period. If you see the S&P 500 sitting down here off this band at 235 to 237, buy the dang thing. Look to try to trade up around the 437 level for the rest of the day. But with that said, let me just keep something else in mind. If we go back to the last meeting that we had back in May, this was a very critical day for the market. This was May 3rd. And if we look at what transpired that day, we had a pop take us into the final hour that day. Now, what happened that day, which was so critical, there was a big sell-off into the close. The same thing happened at a previous meeting back in March as well, where you had a pop into the final hours of that final 30 minutes of Jerome Powell's speech, and then the market absolutely dumped. In January, the market rallied on the back of Powell's comments. So we're looking for this market to move higher just simply because there's going to be some optimism built around the fact that no rate hike has come through. You're going to squeeze out that 2.3%. You may see some short covering for today, effectively knocked out of the system. But then when we get to the 3 o'clock hour, that's where things shift. I'll be jumping over with Vaz at 3 o'clock to trade that final hour. I just want everybody to be prepared for effectively what is coming in the next really 90 minutes of trading. Once 2:30 happens, we start to focus on a couple of different tools. The first one, particularly around the Qs, is if you want to trade the Qs, you can, but you want to look at the leveraged ETF, which is the QQQ. TQQQ. This is a leveraged ETF of the performance of the Qs. So every 1% that the Qs go up, this goes up 3%. So if we're down here at 39.22, you could speculate on a Friday call, maybe around that $40 level to see if it spikes higher. Maybe you just trade the $39 call that expires on Friday. Or you can just buy the TQQQ as well. If this market does start to sour and we sell a pop, from the Qs. The SQQQ, which is the inverse ETF for the Qs, will come down here, likely bottom out here. Because the Qs are going up, this will come down. This is something that you may also want to trade right off of this second standard deviation band. 1973 is currently the level. You buy it, you set a very tight stop, maybe around 1965. And if this market rolls over, it can roll over quickly and this can move much higher. This also has options expiring on Friday as well. Keep in mind, there is going to be a significant amount of liquidity built around this event, largely because Friday is quad witching, and there are going to be many, many bets that are going to be closed over the next 72 hours. In addition, I am watching the SOXL. The SOXL is the leveraged ETF for semiconductors. Now, I know that this all sounds very, very frightening, but I assure you that if you just trade within these bands, you will be fine. So if you look for the SOXL to possibly sell off down to that 25, 21 level, you turn right back around and speculate to the upside for a reversal upwards. And at that point, all you're trying to do is just maximize and make some short-term gains in the next half hour. And then you're going to change your focus. Now, keep in mind, this market could sell off at 2 o'clock and all of a sudden rally into the 3 o'clock hour. It's just a matter of reacting. We don't sit here and speculate about what's going to happen. Finally, I will note this because I had Zelda in the chat with me. She was Zelda's pushing real hard on where the current status is in this market. And Zelda, as rightfully noting, we are overbought right now. On the Qs, we are at an overbought level. And what I have suggested, which is, take it as you will, we continue to see a long-term positive switchover on the Qs, on the RSI, the MFI, and the MACD. The last time we had this type of positive switch was all the way back in August and May of 2020. Right coming out of that COVID period. So can this market run higher logically from a longer term perspective? Absolutely. But from a short term perspective, it does look overbought. We have been in overbought territory going all the way back to May 26th. Momentum turned positive on June 1st, and we have seen nothing but positive energy in this market since then. These things can remain irrational for longer. The RSI that I pay very close attention to on the SPY is overbought, and I mean overbought for the first time since August of last year. Why was August relevant? Because Jackson Hole came along and Jerome Powell absolutely drop-kicked this market, and we moved all the way down to the lows of the year at the mid-October point. And then we had a handful of different pivots globally involving the Bank of England. The Bank of Japan started its process of easing that led later in the year. People's Bank of China with its reopening stimulus as well. And then you had the pivot from the Fed, soft pivot in terms of the mortgage-backed securities. They had kind of pulled back. Not a lot of people caught that in Powell's speech back in October. So as we move into this, all we're going to do is just watch how this market reacts, talk a little bit about it, take some questions, and then just try to set the tone for what comes next over the next 45 days, because this has been a very powerful market. We've had two relatively sizable moves by central banks, October and March. I do fully believe that we could see some sort of correction in the next 72 hours, but from the long-term perspective, the momentum remains strong. Heading into September and October, obviously, we have commercial real estate concerns, big macro stories, but for the most part, keep in mind, we are seeing the most net short in the S&P 500 futures going all the way back to September 2007. And just because they are net short does not necessarily mean they are right. If the buy the dip crowd can continue to squeeze everything higher, then certainly this market can continue to rally. So we start this. I don't know if CJ's here or not. He's going to be coming in soon. We got a bit of a dump to start. It is 2 o'clock.
I'm here, buddy.
4:36. What's up, Ben? How you doing?
I'm doing well. How are you?
That was a long explanation of everything that's going on in the world today. So I'm glad that you're here. I would love to stop talking.
As you do all the time, you have done extremely well. You've covered everything. I mean, I'm sitting in the dugout, and you got every base in the outfield covered here, Garrett. Good job. Always appreciated. Market obviously getting a little bit of news right now. Unchanged is what we see right now from the Fed. 5 to 5 1/4. A little reaction to the downside in what
sell the news event.
this is
Sell the news, right?
Yeah,
Sell the news.
exactly. But, I mean, talk about that. The expectations were exactly this: that we're going to see an unchanged Fed.
Right.
The market gets what it wants. Did it price something else in? Do you think? Did it, and we haven't heard from Jerome Powell yet. I can't hear the comments.
Well,
median forecast. Median forecast rises to 5.6%. So,
well, that helps, right?
Yeah, that is exactly why you're getting your pullback right now in the cubes and everything else. You've got the median from the Fed saying they're going to be taking rates to 5.6%. So a little higher. Yeah. That's
a pretty significant hike, to be honest with you. And now the overall expectation is, you look at the possibility of a pause here. They're going to look and see what the Treasury General Account does, how that impacts the repo market, and how that impacts interest rates elsewhere. The Treasury Department's going to have to obviously raise hundreds of billions of dollars, if not $1 trillion in the next 12 months. That's going to obviously have an impact on the markets. But this 5.6 number is really interesting because it goes back to what Waller said. So now the question is, if you look at this CME number and you look at what happens here in July, how quickly does this change, and what expectations are heading into that next meeting? This is going to be a very interesting report when it comes out in 3 weeks. So 59% probability of a rate hike in July. We're going to look for that to probably increase, right, Chris?
Yeah, actually it was just at 63 a couple of days ago. This has been bouncing around. I haven't said this in a while, like a BB in a boxcar, that number for the July meeting. And that's on the 20. That's a late meeting too, right? I think that's in the late 20s of, we're 59.1%. And I wouldn't be surprised if you see some changes to that, especially with that 5.6. That's going to be an interesting little dynamic here. What are you going to look for? And we got the number out right now, and the cube's down 0.25%. IWM has dropped down 1% right now. So the areas of the market that have been rallying on fire are pulling back, which is not a huge deal. I mean, KRE's down 1.3%. XRT retail, which has been plotting a huge comeback, down 1.65. So a little bit of could this be a flesh wound, I guess? Let's go all holy grail on this. And is this a flesh wound, or is this, something more severe?
I think it's actually something more severe. I'm trying to pull up a chart real quick, and let me just see let me just transfer it from one computer to the next, because I want you to see what has historically happened when the Fed pauses rates. Just give me 1 second. I just need to move it from one place to the other. But this is a pretty damning chart that I just found. So if we pull this up real quick and we go move it over here and then we go here, this is what happens when the Federal Reserve cuts and pauses rates. You see that?
Oh, yeah. Oh, no.
Okay. So here you go. This is a damning indictment of kind of what is probably going to come. We could obviously see that drawdown. So, but again, it's going to be very, very difficult to try to predict if and when that happens. But money's screaming out right now, and it kind of defies, some of the things that I was saying about 15, 20 minutes ago. And that happens because the second rate hike was was completely unexpected out of this statement.
Yes.
The expectation was, okay, we're going to go to 25 points. We'll go to 5.25, but now an admission of 5.5. I hate to say this. Now we're actually going to have to start talking about 6%. It's like there's an underlying issue here, right? And the reality is that, like, every time that they say one thing, it ends up moving 2 lines further. So this is where Jamie Dimon was talking. But once again, you look at this, it's weeks and months. You see a big drawdown on the S&P 500. The last 3 have been monstrous. And, once again, it has this feel of 2002, 2008. It's just a question of whether or not this market is going to give up. And if the buy the dip crowd just finally says, you know what, we made enough money, let's get out right now. But this is screaming lower. So it'll be the way that I typically trade this. I'm waiting for Powell to speak, but
Right.
I have not.
Right.
I have not seen a move like this in some time.
Well, this is ripped. I'd call it a rip, at least in the last 10 minutes, 5 minutes or so. You know what is interesting about this chart is this I've not seen, and I used to do studies on Fed funds rate and the relationship with the S&P 500, and this follows one of the oldest ideas or the oldest thoughts, which is if the Fed is, and you can flip that over, Garrett, and you can look at when the Fed is lowering rates, the market response is usually poor. And it's not because they're lowering rates. It's because they have to lower rates. This gets down to the mechanics of why the Fed moves those rates. So if they start to drop rates, it's because they have to, because something else has gone on. And you've laid out a number of those concerns here. And I think a lot of people are looking at it through the rose-colored glasses and saying, hey,
Right.
we're going to see cuts before the end of the year, which is good. But no, at this point, I mean, an ideal situation, nobody talks about this, for Jerome Powell would be the market continues, they get to leave rates where they are, and he gets to keep all those bullets in his gun that he's put in over the last year for the next crisis, because that's what we lacked for the last couple of years, that ability to come off the floor, and you couldn't drop rates any further. I mean, I think any Fed chief wants to take the helm and maintain the helm and have, I don't know how many cuts in their pocket.
Yep.
They don't want to be left close to zero where they can't do anything but start to do quantitative easing. And now you're talking about balance sheets that have to be unwound that are going to take even more time. So that chart, I love that you pulled that chart up because it nails the exact fundamental nature of why we'll see rates go down. It's because they need to go down.
They need to go down. Yeah. And I mean, they've absolutely nuked energy. XLE is getting hammered right now. You're starting to see a pretty sizable, I'm looking for an update on my intraday data. I mean, you got money just screaming out of everything right now. So this was a shot to the market. This was a look, you break it, you buy it, and you look right now to look at Tesla. I mean, Tesla's collapsing. That's a big move down. So again, I'm not going to sit here and overreact to all of this news yet. I'm just going to try to wait and see what happens when Powell speaks. And then what happens at that point is, try to figure out if we're going to buy the dip and try to trade this into the close. But this was a surprise. We have not had this happen in the 18 months that we have been doing this trade the close event.
Yeah. Let me ask you something a little broader here. Looking past the next 2 hours and going out to the next 2 weeks here, the safety trade, which has been the thing that has been lifting the market for the whole year. And you know how much the damned safety trade, right? IWM now gets knocked down between below its 20-month, which that's been my signal that if that goes above the 20-month, the IWM goes above 190. Now you've got broader participation in the market, and I likened it to me dragging my dog to the vet yesterday, Garrett. I get dragged into the backseat of this market and have to ride to the vet. But does the safety trade, Microsoft, Google right now, I think looks great for the picking. Apple, do these things all of a sudden kick back up and say, forget about the fact that we're at these highs. We're going higher because that's where everybody's going to pop their money. I mean, they're going to continue to favor that. I thought there was going to be a migrate, and we could. I mean, we're 9 minutes after this.
Yeah. So, I mean, my thesis and the thing that I talked about earlier today, and I think that this is something that a lot of people haven't really focused on, is that if you look at the companies that are the big components of the S&P 500 and the NASDAQ, obviously everybody's only been focusing on AI, and they've just been saying AI over and over and over again, when in reality, the way that I see it, venture capital is destroyed. They've destroyed the venture capital industry right now. So there's no competition coming down the pipeline for a lot of these big tech companies. They're going to get all of that human capital back because people are going to be looking for jobs, and everybody wants to work at Google. They have financial advantages because they run everything through their balance sheet with cash flow practices that give them interest-free rates. This current situation right now that has been created by the Fed. You had a decade and a half that favored these companies because of low interest rates. Now, all of a sudden, they have this fortress around them that they have no competition, they have capital advantages, and they're going to get all the human talent. So the way that I see it is, these names look like they're going to continue to move higher for longer because the tech oligopoly has only gotten stronger in this environment.
Yeah.
Like,
Oh, man.
it's tragically true.
Yeah, it is. I hate it when you unfold something like that, but it absolutely is. I mean,
Makes you want to take a shower.
Yeah, it does. There's no leveling of the playing field. And you would have thought that, it's funny when we watch the cuts that were made over the last year at some of those companies you just mentioned, they were minuscule. I mean, they were small. I think they were almost, call them ceremonious. Hey, we're going to cut and we're going to give this image that we're cutting back now. When in fact, they did, but you still got a Google that is not even close to where they were 3 or 4 years ago in terms of the number of employees. And you're right. This is just at this point, if you're looking at it, if you are somebody who's sitting here reading the tea leaves of what's going to happen in 5 years when everybody's looking to make those jumps into the areas of the market or that new technology that's going to break out, nobody's going to want to leave Google or Apple. What about let's talk about a couple of sentiment things for a second. I'm looking at the bid right now, which is the BTD Capital Fund. I don't know if you've looked at this. It's an ETF that literally is buy the dip. DIP is the ticker symbol. And it's not doing great. And it's not widely traded. So, this is one. But this is the kind of stuff that when I look at this, and this thing just started trading, in December.
I don't know. Okay.
2022. The sentiment, and because you mentioned something last week, and I've talked to a couple of people about it, and the contrarian nature of this market, and it truly is. I mean, you nailed it. And I've got Humphrey Neal's book, The Art of Contrarian Thinking, right here on my desk because it always stays here. I mean, that's where I was educated. And for you to kind of open my eyes wide open again, I went, let's get the other sentiment reads out there. Is the buy and dip starting to wane simply because everybody's doing it and they're getting nauseous? And you see, that you can go out and buy Apple and just hold it. You can go buy Google and hold it. You can go buy Microsoft and hold it. Hell, you can buy Carvana and hold it and get 100% out of it in a month and a half. What's your read right now on the sentiment out there in the market?
Well, I mean, overall sentiment. Go ahead. I think
that factors into what we see over the next 2 weeks with this Fed move.
Well, you're in an extreme greed territory. We're at like an 81 reading on that. So, this is where the retail crowd, they don't come in and they don't buy the March dip. Because that's when peak fear was. Now you're in this kind of euphoric environment. And one of the things that I did note is that from a long-term perspective, you're seeing, this kind of switch over positive on monthly momentum. But for the short term, I think that this market has been looking for a sell the news type of event. I mean, this has just been an absolute tear. And I think a lot of people are, the big question now is, who is selling right now and who is selling to whom? And the way that I view it is it's going to be large institutions. They're going to be willing to sell to retail traders who are coming in late to the game, who are going to try to buy the dip right now. And look, as far as the idea of zero date and buy the dip and everything that comes with it, I don't think that's ever going to go away in the markets. I think that's a permanent part of the markets moving forward. There's too much money in it. There's too much, these funds are making an absolute killing just doing these types of buy the dip types of moves. But if they are based on a momentum indicator or a momentum reader, these things will shut off. And if that is the case and the funds are dumping, then all of a sudden, you're taking 435 on the SPY and you're taking it down to 405, which is that kind of baseline support level coming up out of that October sell-off into the March sell-off. And now it kind of forms that like perfect groove all the way up. What are your expectations for buy the dip?
I think that we could use that, and I hate to be the person that says it, but that healthy correction in the NASDAQ 100, I think everybody's kind of sitting on the edge looking at it going, I really want to buy it, but do I want to buy it here? We saw it try to make a little bit of a move, last week when you saw a little bit of a rotation start, when the small caps, the banks, the retailers, all those dogs that have been left behind started picking up. I thought that was going to be the pause that refreshes for the NASDAQ 100 because you mentioned it. We're oversold. I mean, if you look at anything out there except for the IWM, and it's getting close to being oversold. We're way oversold, and or overbought rather. I always remember that old thing: overbought can become more overbought, and that's the one that tends to happen. Oversold doesn't usually become more oversold, but I think that if you had a little bit of a pause, remember July is a great month for the market. I mean, seasonally, it's a good month. Earnings are coming. People feel burned from last earnings season because expectations were low. They remain low. And if we're going to roll in, I think you've got to buy the rumor that's going to kick in pretty heavy. And it could be in turbocharged fashion on the financials. Because remember, we didn't see, and there are all kinds of risks out there for the financials in the landscape, but we didn't see that happen. And it was almost to the contrary, where it was a show of force in the financials last quarter during the earnings season. And I think everybody has their expectations so low that they're going to say, you know what, I'm not going to miss it this time. I'm going to jump in. And I got lucky because of regionals and everybody made a move down. That's what I think drives us. But to get to your buy the dip, I think it takes more than a couple of hours. I think it takes a couple days. And if we hold 20-day moving average on the cube, if we hold that, that's where I think this market goes wild to the upside again. And that takes you down to 350.
Right. So now, if we just look at the performance of the S&P 500, the SPY for the day, you have this sell off that starts the day at 9:35. You pop, and then you sell off here. But look, this is the last 6 meetings. And where are we right now in the period, right? We're selling off. We're kind of dripping lower. And then it is that 230 period of time. And that is what Powell speaks. And that's why I keep saying, like, I like to wait until 235 to 237 and then take a little bit of a speculative trade to the upside. Because, again, this is the average performance, the 6 meeting performance. This thing can move lower. And then all of a sudden, Jerome talks, you get a little bit of a rally, and then you sell off into the end of the day. It's hard to see reason why this type of thing would not happen again. You got people shorting right now, relatively short duration, taking this thing lower. This is where, if I get down to 433 in the next 12 minutes, that's where I'm going to probably speculate around the 434, 435 for the end of the day.
Yep, I got to agree completely. If there's, and this is not me, giving him a stamp of approval, but man, one thing Jerome Powell can do is talk the crowd up. He can come in there and soothe everybody down and say, this is what it is, even if it's been bad news. And I made this comment to one of Tom Gentile's guys earlier today. I have, I've been through Greenspan, I've been through Bernanke, everybody, for the last 30 years. There has not been a Fed head that can, first of all, that's done a better job, I think, of telecasting what they want to say. I mean, Correct. He does a pretty good job of getting it out there, even though the market's telling him that he's wrong. He still gets it out there. And then when he follows through on what the market think is wrong, which is what they've done today, and they've told us higher rates longer. I mean, that's been his message for the last 6 months. So to see a 5.6, which goes up from, I think we were at 5.1 to 5.4. Is that what the range was before today?
It was 5 point. Yeah, it was 5 point. It was 5.4. Some. Yeah, 5. Yeah, you're right.
I think it was a range.
How
of
am I?
5.1
I gotta go. I gotta go down, CJ. I gotta get my chair down because I'm looking too tall compared to you.
You gotta lean back. It's a low ride type. Yeah, you gotta lean back. So this guy has said higher, longer. So for them to go to 5.6, this is again the market's expectations. Tail trying to wag the dog that the Fed should be dropping this stuff. And they came out and just did exactly what he's been telecasting all along. So my guess is he's going to be able to come into the room, soothe everything down a little bit. And maybe this gives us the pause. Is it any wonder also, I got to go on a side note here that'll be funny. You saw the pictures of him at the Dead and Company concert a couple days ago, right? Up in Virginia. That's why the guy's so chill. I mean, he likes the dead. And this guy, for all the problems that we've had with him and we can bitch about him, you know what? I think this press conference that'll start in 10 minutes?
Mm-hmm.
He'll do what he's done, and he's given this market confidence. A lot of the times, though, that erodes right away, and we crater into the close. We'll see.
Yeah. Well, again, you're at 435. 435 call for today is trading for about $1.10. And you're down at this level heading into the meeting itself. You could just kind of speculate and hold that for 10 minutes and look to see, if we get some sort of just reversal before he starts talking. It's entirely possible. So that's kind of where my focus is. It's around the 435. The 436 is a little bit more speculative. That's up where volume weighted average pricing lives. It's 77 cents right now. And as we've seen time and time again, Powell speaks 235 to 237. Let's determine which way the market is going to move from there. But I do like to kind of speculate based off this, keep a relatively tight stop, even if it's 5 cents, 6 cents, whatever. And then we're just trying to see if this market wants to move higher. And look, we might get back right to 435 by the time that I finish this very long sentence.
Yeah. Pull this oil trade apart for me too. Because it's had me scratching my head, and to see it pulling down the way it is. And by the way, dollar making a nice little strong move after that announcement. Actually, USO trying to bounce off 6140 right now, or 640 right now, 6140.
Yeah,
pull this apart for me.
Weird to see two other things, right? The Russell falls 1.2% and the VIX is down. Like, okay, that makes sense. Oil prices, it's not just the current status of the higher dollar. There were some drawdowns once again from the Strategic Petroleum Reserve. You saw, I believe, a small uptick in inventory levels as well. So that's one thing to keep in mind. And then just, again, there's a game within a game with the current status of oil prices. The JP Morgan downgraded its final prices for the end of the year for Brent to $81. Again, I keep telling people, invest as if oil is between 65 and 70 for the rest of the year. Anything higher than that is gravy. The IEA increased its demand forecast, but there's that game within the game involving OPEC right now. I think that there's something going on involving their, the actual personal wealth of some of these sovereign wealth funds. And I think that there's some kind of short game kind of trying to target some of the hedge funds that are managing that money.
Yeah. One more thing, and I'm hitting all over rates, and I'm sorry I'm taking us all over the place.
No, you're good.
How about the 10-year yield? 10-year yield getting ready to take out the 386 level or so. And if you're hindsight 2020ing this, you look at the 10-year and say, well, it's been rallying since the beginning of June. Was this really a surprise to see? First of all, the hold is not a surprise, but the 5.6 is what the market is acting like it's a surprise. Bond market was ahead of this. If you look at the 10-year, I mean, they were reading this one a week ago or maybe 2 weeks ago.
Yeah, and that curve's flattening out, correct? Like, isn't the 310 really come down dramatically? But the thing to go back and look at that chart, that has kind of flattened out. That happened back in 2001 and happened in, I believe, late 2007. So, you look at that and you say, is this kind of a eye of the storm that we're sitting in right now? And that's where I think the more bearish sentiment that exists in this market, looking out into later this year, the commercial real estate that has to be redone, the warnings from Yellen about the current status. Look, I honestly think it's very critical that you listen to Yellen talk about some of these things. She said yesterday that the dollar reserve may go away very, very slowly. And I think that that's a long ways away. And I think they asked Hemingway, how did he go bankrupt? And he said, well, gradually and then suddenly, right? And, there was a slow bleed off and then all of a sudden it just completely goes away. she's getting out in front of that. She's getting out in front of, the possibility of a banking thing. And the reality is, I think that this is a person who's worried about her legacy. And I think some of the other individuals are, where they don't want to sit here and have some sort of event transpire in early 2024 where they were sitting here saying that there's no problems ahead. That was the lesson of Bernanke back in 06, 07, 08. And why, you look at Bernanke and you look at what Greenspan did and some of the things that they said, because they were dead wrong. So they're at least kind of hedging their bets that, if they have a soft landing, that they get to pat themselves on the back. But if there is that hard landing, then they get to turn around and say, well, we did try to warn you.
Yeah, I'm looking at some notes here too. By the way, it was a unanimous vote on keeping everything stable.
So now the question's the dot plot for the minutes that'll come out in about 3 weeks, July 5th. And
right.
Now, the SPY's just bleeding. It just keeps bleeding off. So Powell's going to have to come in here relatively soon and provide something, some sort of positive sentiment, or you're talking about you might be talking, you literally could see 425 by the end of the day if this really goes, like, if there's just a cascading effect similar to what we saw in previous meetings. So keep in mind, the typical downtrend is from about up to 0.3% on the day to down at least 1% on the SPY from its levels heading into the meeting. So right now the SPY's down, or S&P 500's down 0.6. You would be talking about what's another 1% from there? You maybe 429, 40, 42.80 would be probably the worst downside for the day. And the upside's right back where we started. You're right back up at this kind of 437.80 level. But it all kind of comes down to what Powell does and what he says.
42.80 is that whole consolidation that we saw in the beginning of June. So you're going to find the market getting sticky right there. If we were to go down that way. Who's got the biggest selling risk right now as we head into let's say that this goes the way that we've seen it go? You get a little bit of a reprieve from the selling out of the gate as Powell starts to talk, and then things roll over. IWM, SPY, QQQ. Where do you see the most risk right now?
I think it's in the Russell, and the reason remains the same. Look, capital likes to consolidate into these big safety names, right? And it would used to not be that way, but it's the FANGs, it's the bull market, it's the FANGs. So you look at the Russell, and what are higher interest rates going to do to the 30% of zombie companies that are part of the Russell 2000. You also do have the reconstitution coming up, Chris. Obviously that's going to be critical. What is that? The 23rd, 24th?
I think it's the 24th.
So, you've got a lot of names that could be, completely fall simply because they're probably going to be delisted. And then ultimately you have this other kind of group graduating. But look at some of the names that came up last year. Beyond Meat, right? These are not good, healthy companies in any capacity. So they're typically, that anomaly of the Russell leading into this period is you see a lot of strength from companies like the second that they come on and, they go up maybe 15 to 20%, but then you work into the backside of the year, you get into September and October. And that's where there's a lot of weakness because the numbers on these companies are not as pretty as the ones that are joining the S&P 500 or, any of the other indices.
Correct. You know what? I don't know if you've looked at the long-term chart. I've been harping at this for a while, and if we can get it up on the screen of the Russell, this will be incredibly timely when you look at that 20-month moving average. Garrett, last time we tried to do this exact move was February 2023, and there's more momentum that's been behind this because we've seen money coming into the small cap. But man, that 20-month moving average, in case people don't know, that is that line of demarcation for the long-term outlook on the IWM. That is the thing that, from the technician's perspective, you say, we have moved into a bull market in the small caps, which then broadens the rally. The thing that everybody has to remember is you have to get closes above it. So we got to wait till the end of June to see this. This is just, if we were to see the IWM absolutely rotate back out, you are going to see a situation where, I hate to say it because I've been warming up to the IWM. That's what's dragged me into the car. But that will be a situation where you turn tables and we go right back to the bifurcated market. This, parks closed. We're not going to see exactly the companies that you're saying, the ones that we need to see, the ones that are more, and this is why the IWM gets hit with an announcement or an indication that rates are going to get higher. These are the companies that have to pay for that. They're the ones that are going to pay the higher interest rates. They don't have the cash. They're not out there, with a cash flush. They're out there trying to finance their businesses right now. So 5.4 to 5.6 hurts them. That's why the IWM pulls back 1.8% right now.
We're waiting for Powell to speak. He's got a room full of reporters. He has not shown up yet. Here he comes. He's bringing roughly 5 pieces of paper with him, and he's good to go.
You know what? That was the other comment with Tom's guy this morning, or just a few hours ago. There is no Greenspan briefcase indicator. Powell just walks in with this piece of paper. At least Alan Greenspan gave us a briefcase. Hindsight 2020. All right.
So he's just talking about how can you hear him?
I can't. I'll turn it on for a second. I'm going to.
I have it. I have it on.
Okay.
He's talking about price stability and how sorry he is that inflation is high. And maybe if he just told Congress, hey, don't run a deficit, we could move past this.
Well, go back to what you just said about Janet Yellen and worrying about her legacy. We can't go without a deficit right now because we have to do what we're doing to, whether it's the pandemic that's added to it, whether it's the military action, all of these things have piled up. And this is just an untimely time for us to be spending like crazy. They can't slow down. Congress can't slow it down.
All right. So again, you're going to look at the 433.68 number if you get down to that level, and we're going to watch this. And somebody said, in the chat, well, 235 to 237 will tell us where we close. That's not my point. It's 235 to 237, probably into about 3:00, and then you look the other direction. And what we have seen traditionally has been a scream higher between that 235 and 237 period. So that's kind of where I'm locked and loaded right now. I would like to see this thing peel back to 433.63. And then I'm looking specifically at the 434. And in that time period that we had chatted, right, the 435 is currently for under $1. That's kind of where I might speculate. And then you got 230. You're 3 minutes away, and you're already getting a little bit of movement already. I'm not really listening to what he's saying.
I'm trying to get a little bit.
Yeah,
we're expanding the.
Or purple tie though. Purple tie.
What's that?
Purple tie.
Yeah.
No political statement, right?
No. Well, he's still chill from the Dead and Company concert.
There you go. Yeah, he sounds like he ate a brownie before he came out here. This is all not. Oh, there we go. There's the 435. That's, again, look, we just start to move higher. The 435 went from 98 cents to 133 in that period of time. So I'm looking for this to continue to start that period higher. You're 3 minutes away from where the market tends to make a decision, but we might jump the gun a little bit today. We'll see.
That 435.50 really is what, if I'm looking at it from a 1 minute chart here, I like that 435.50. If you take that out, you start to fill back up to 437.
I mean, again, you just trade the I was trading the 435. It was 80-cent stop. See what it does. He's literally doing just a full sweep of all broad macro stuff at the moment.
Wages have come down.
So, yeah, unemployment. Not really
this
much
is going to be a Q&A, and that's what normally trips us up. The Q&A is what normally gets us flipping if we flip.
Mm-hmm. Nope, he stumbled. Market falls.
There's your well below our 2% goal. So he reiterates that again. So on that note, since we don't want to say nothing while we're listening to him, how hard is it going to be to get inflation down to that 2%? I mean, if you look at what's going to drop off next month in terms of CPI, it's the last of the behemoth bars over the last 12 months. So we're going to see another drop next month. It's going to be just because.
Yeah, you might see this go down to about 3.2%. But once again, it's the PCE number that matters most. He's talking about that right now. 3.9 for core. So they've got a ways to go on this.
Yeah.
And it's going to take a remember, inflation is meant to be drowned. And it was interesting to watch, the White House and Schumer take a victory lap and saying, yeah, we've cut inflation in half. Well, no, you didn't. Your rate of inflation went lower. But the problem with this is that it has been 100% the Fed. There has been no support from the Congress, and there's been no support whatsoever. And now look, now you got 236. Here we go. See what happens at exactly 237. I bet we might be at 437 by in 2 minutes. This is getting fun. There we go. So that 90 cents just turned into 145, and my stop is back at 140. And I don't see any real reason why this won't move higher through the next 5 to 6 minutes. He's not saying anything that's.
No, this is.
He's good at this. He's good at this. He's really good at just sticking right to the narrative. No language that's threatening. $152 right now. So now the stop's raised to 140. Telling you. It's always a fun day. Okay. So my stop is 140. I'm at 147 right now. We'll just go from there. It's a 40% win in 14 minutes. I might stop out right here. Yep, what? Just stopped out. Just stopped out. So we're not getting the. I think we're going to turn right back around and move higher. It's right off that first deviation band.
435.50 is that number. You got to see it crack.
There it goes.
There it goes. You get to close the 1 minute close
again, and you could trade this. You could trade this with sell orders too. I mean, keep in mind if you're buying here, you can always just set a limit and just try to get out of it at a higher point. I think we're going to just see the repeat of what we've seen over and over again. We're probably going to come right up here, maybe hit 438, and then we're going to sell right off into that last hour, and that's it. Here's the dot plot. So this is important. So the dot plot's taking you up to 3%, but nothing really bad. No real significant shift on that long-term period. And that's it, everybody. At 435 is now at 160. That's a 60% move. I mean, I stopped out, but it is what it is. I'd love to see this thing turn right back lower. Give me another reason to get back in right here at 435. And then I would speculate around probably the 436, which is currently trading for 92 cents, and just do that over again. We'll go from there. So what did you learn, Chris?
I learned that nothing's changed as I listened to him. Nothing's really changed. Absolutely nothing's changed.
I'm about to take a nap. This is like Mystery Science Theater 3000. We should do that.
It really is. It really is. I want to hear the first question. That's the question I want to hear. It's always the one that kind of kicks things off and sets a tone for what's going to happen. And that's usually when you see your directional change or your follow through. It's 435.50 on the SPY.
Mm-hmm.
You know, oh, here it is.
This woman is asking a very long question. There she goes. She's done.
So she's basically saying, why are you?
$435. So the 436 right now is 90 cents. If I'm trading that, I'm buying it here at 90 and I'm setting a stop at like 75 cents. And that's it. And we see if we just move higher from here. This is consolidating, Chris.
Yeah, it is. Right across that 435.50.
Mm-hmm.
Doesn't want to leave it.
Yep.
That's where you broke down. If you look back at the 204, 205 bar, when we were coming on a 1 minute, we paused and held there for a second, and then you fell right off the cliff.
Yep.
You take that 435 out, and you start to look at a 437 on the spiders. You get $1.50 out of the spiders on the rally.
IWM maybe up to 186. You could speculate around that. And then the Qs, the TQQQ, which we were talking about earlier, that came right off that band, 38.66. Now watch it push toward VWAP. It's already made $1 in the last 15 minutes. So we talked about that beforehand. I was keeping a closer watch on the SPY because I prefer to just trade around these individual bands with very defined numbers. And again, walking away with about a 43% gain and now just speculating around that very specific 436, which is now up to $1.09. So back at the $1 stop, and that's it. Yeah. So there's no real resistance here at the moment. I think you're just going to look to see if this market can get any legs, push higher. And then as you move into that final hour, it's really a question of what the big funds are going to do. And that's why I'm keeping a very close eye on the SPXU, right? The SPXU is breaking down. It had that spike to start. We moved from effectively 1130 up to 1160. Now we're coming back down here to maybe hitting that 1137. As I look into the end of the day, if I'm looking for a sell-off, I'm looking for this to push another 20 to 30 cents. So I would speculate on the SPXU in that final hour. And that's a relatively easy thing to speculate around. It's currently at 1140 right now. I think the 1150 call for Friday is somewhere in the 12 cent range. So that's kind of where my focus will be. It would be looking for a sell-off, looking for that rollover, and then either the $11 call for Friday, which is 45 cents right now, or the 1150 call, which is about 13 cents. And we're going to be patient with that. I don't care what he has to say for the rest of this time. I'm only watching price action now. All right. Anybody have questions in the chat?
You know what? I haven't looked, actually. Be good. No, we haven't. Throw some questions in the chat if you got them.
Gabe's making money. Okay. Where's Vaj? She's on at 3:00. Put Palantir on sale for me. I like that one.
It's not going to. I don't wanna.
Palantir got beaten. Yeah, Palantir got punched a little bit at 246, and it's back up another 28 cents. It's hard not to like Palantir for the long term. That was my top pick of the year. Did I lose you, Chris?
What's that?
What was your top pick of the year?
You know what? AI was one of mine, the CA3.
That's a good one.
Yeah.
SPY's starting to run higher now.
Yeah.
And there we go.
Take out this
Keep going. Yeah. So 436, get out of that.
Turns into a 437 right now. Actually, you want 437.20 is what I'm now. 437.20 is the spot.
And that 436 call is now at $1.38. So another win there. And again, you're just defining your risk. And I mean, you got to take gains once we hit here. The 435 call is doubled, right? That's up to $2. So anybody who's stuck around there, you sell half of it.
Yep.
And then you look and see if this thing can keep going. You can just feel this thing's going to roll over in the afternoon, right? Like 3 o'clock. This does not look. It's crazy.
Volume's
It's
picking up.
absolutely crazy that it just keeps happening.
Pull that chart up again. Can you pull the chart up of the average reaction?
Yeah. I got it right here. I mean, look at this. Is it up? Oh, it's not up. One sec. Let me.
Nope.
Oh, I've been looking at the wrong damn screen. Sorry. Here you go. Look at that.
Oh.
So it's at like 250. This tends to occur.
You lose the roll, yeah.
So you came right up to VWAP, dumping the 436 by the way. And now can it get just a little bit more legs for another 5 minutes? And then do you look the other way? And here, that's what I was talking about. SPXU. If you're going to speculate for the rest of the day, if you're going to speculate on a downturn, this
36.
SPXU, the SPXU, like just took some gains. Can you just kind of speculate now on this market giving you the sell-off? The 1150 calls for the SPXU on Friday are 12 cents.
Mm-hmm.
You double your money. I mean, you this has already hit. It was 25 cents right here. Now it's back down to 12. So, what are you looking at?
I'm still looking at the spider. Here's your test at the 436. That turns in your line. You got to hold. After you reach up to the 436.50, you break up there. Now you got the 437.17 that comes into play, or 437.20, according to what I'm looking at right now. But this 436 has got a hold right now. God,
Out of hold, but
looking at wonky volume too. There's nothing coming through. If you look down at the volume here, a little bit of a surge and then just absolute drop, pop and drop, pop and drop. Nothing's coming through, and I don't think it's going to until the end of this conference, right? Because
right.
Nobody knows what the next question is going to be.
That's another really good point. But as far as price action goes involving the institutions, they will dump at around 3 o'clock if they dump. But
yeah,
I mean, I'm done. I've wrapped it up. Now I'm going to wait until about 3:15. So if the SPY goes to 436, 437, well, I short it into the close. I think, you want to wait until 3:15 to see what the price action looks like, because as we've noted, if you just look at what the last 6 meetings have looked like, we are here right now. We're up here. Now we've gotten back to that kind of equilibrium line, and we have seen these kind of pops into the 3 o'clock hour, but it's that last 45 minutes where it's been, these are the last 6 meetings, and this is the average. Now that we had one day where it was down 7% or something absurd, right? Like there was a 7% move up and down. Yeah, it was 5, maybe it was 3.5, but it was whatever. It was a massive move lower. So this is 330 right here. I mean, that's spooky. That is very spooky. So let it squeeze higher. Let it keep going. And again, you can just trade around this number right here now that you're VWAP and try to see if you can get another move up to another band. And that's 438. And if it doesn't come, go the other way. I don't know if it's going to go down. I think that's the key thing to keep in mind. I am looking at previous I don't know. I'm using these lines to define my risk. So if we head into the last hour and we're right here at volume weighted average price, and it's at 1137 or 1132, and the market starts to go the other direction, I'm going to speculate to the downside. But for right now, I'm not doing anything.
I am going to
Higher.
follow exactly what I was saying on a daily or monthly basis, and I'm going to keep watching the IWM here because I think if the IWM gets back up to a 180, let's call it 186.50, I think the S&P 500 then acts a little stronger because you're definitely seeing more of the reaction here in IWM.
Mm-hmm.
And that's where we'll see. And that has been the case when we've seen those rollovers. Cubes have been a little bit insulated. IWM has been smacked around. I mean, as Mark would say, taken out behind the woodshed here. If you get a little bit of continuation here in the IWM, and it looks like the volume is a little more solid here too. I think the S&P 500 actually has a chance of continuing. But that chart, where's that chart? Where's that chart from? Is that a bespoke?
I think it is.
I think yeah. That chart is just stunning.
I mean, look, you gotta ask yourself, if you're gonna do a lottery play, you're gonna play the lottery, then the 1150 call on the SPX is $10. And if this market does sell off into Friday, but then you can turn right back around and buy the $11 put for 3 cents. I mean, this is kooky. SPY broke VWAP. There you go.
10 minutes from 5.
It's unbelievable. So now what we're looking for is just some sort of like irrational rip higher that just like I'd kind of rip your face off 2-point move on a Thursday or Wednesday afternoon. And then that's where we start to have that conversation once again about going the opposite direction. That's really where my focus is. If you get up into here, up to 439.50 for any apparent reason, that's where I would be looking to go short. There's really only 2 places to go short, here and here. And right now we burst through that. So there we go.
438.50 or 439? Did you say 439.50?
439.50, yeah.
Okay.
I mean, that's how wide the bands are at the moment.
Yeah.
That's the top of the second range. The bottom of the range is VWAP back at 436.70, 436.65. Now you're moving lower.
I haven't looked at this. What
this is wild.
Hammered in the spiders. Like if you look in the SPY at the stop level.
Let me pull some stuff up real quick.
But that's because Humana's getting smacked, but that's because of what Humana did today. United Healthcare, same thing. CVS, so it's all Progressive Insurance. I mean, those are your bottom performers on the spiders right now. Your top is Oracle, makes sense. Stryker, Boston Scientific.
You've got
all the medical device.
You got a big blackout period coming out too in July for this next meeting. I don't know if it's like 2 weeks long, 2.5 weeks long.
Yeah, this is going to be a long one.
This is going to be a very long 6 weeks.
July 26th. Yeah, that's a poke. What's that? 5 weeks? 6 weeks?
6 weeks. Yeah, that's in line, right?
Well, and then you've got the longer poke. You got July until September.
But then you have
a Jackson Hole in there.
Jackson Hole in the middle of that.
Yeah.
With earnings. Wow. I have a headache.
Here's your S&P 500 testing its fortitude at the 436.50.
Again, just algos continuing to talk to one another. Not a whole lot else. You had to buy the dip back here at right before the speech, which that was unusual. We had typically seen the move come after that, but sure enough, we got that move right at 235. Took us from 434 up to 437. That's a good little 2 days, two moves, right? The 435 at the call and the 436 call to trade around. So the day's done there. Now the question is, what are we seeing in terms of movement in momentum from the broader market at this moment. So let me pull up some data real quick. Just take a quick look at that. And then I'm heading over and hanging out with Vaz at 3:00, Chris. I think Chris is frozen. I think we lost him. There he goes.
I'm still here. I'm here.
Oh,
I'm
okay.
here.
So we're seeing, so there's a big drop in buying pressure as of 2:40 today. That's relatively bearish. Some selling uptick that has come through. The selling stuff that seems to be getting a little bit of a dip buying, but also like categorical weakness. It's every sector. All 11 sectors have an underlying negative trend for the day. But it's weird because there's no stocks that are in like a breakdown pattern. Like healthcare for financials, that one weird AAMC stock's down 23%. But then you got companies like Next up 29% today. Healthcare, IVA up 26% today. There's nothing really in a breakdown mode.
No.
So
what's the interesting thing that sticks out on my screen, the green that is sticking out the most right now, transport. I mean, we know the jets were taking off, no pun intended, but all of a sudden the rail is getting in on this. As you see CSX and a couple of other, that's a mind bender. If you've got, you got to go old school Dow theory now.
Right.
You look at the transport starting to take off with the rails. And I think the rail is important here because the jets have just done it because of the consumer discretionary implications looking forward. Everybody's spending. But to have the rails and some of the trucking companies showing strength today and breaking above their March or their May highs, that I think is the most interesting move that I'm seeing today. Including, the regionals. That's natural. Regionals, biotech's down 1.8%. It's because it's been a decent trade. Risk off, right? Risk off on regionals, risk off on biotech. Oil, you've already hit that. But man,
UTS. This is a problematic chart though here, Chris. This is the UTSL. This is the leveraged ETF ETN around utilities, coming up off this. That's been the trend line coming all the way since October. But utilities, you raise interest rates to 5.6. I don't know how much rate hikes are going to help them, or the utility rate hikes compared to. Is this going to be the first thing that starts to break down and revisit that low? Possibly in that $22.50 to $23 level. I'm watching the XLU now. I think that's going to be a place of potential weakness if this market goes the opposite direction. Not a whole lot of movement downward, and then you got to watch real estate as well. Real estate, but no knee-jerk reaction today.
A trade, or not even a trade, but a buy, is because people want the dividend yield. Dividend yields are thrown out the window right now. Look at the DVY. Correct. Look at the Procter & Gamble. Look at the Colgates. So nobody wants.
Who is not going to buy U.S. debt at 5%, 6%, possibly higher? Who's not going to do that? This is one of those things that, I know that we talk about equities all the time, but if you're going to be talking about rates moving up to 5.6 and maybe even higher than that, you're going to be looking at an environment where you're going to see investment grade bonds at 8%. And that's like once in a generation.
And more importantly, one of the reasons your regionals are down so hard today is because they're going to see money coming out of deposits. And it's not because of fear of failure. I'm going to take this out of my ear. It's not because of fear of failure. It's because there's a better show in town. And now your banks are hamstrung on lending, which is where they make their money.
Right.
It's just a continuing little circle here that's just going to feed itself. And that is your regional weakness right now. By the way, nod off to you on the Fifth Third too. We were talking about this yesterday.
Love Fifth Third.
I absolutely love Fifth Third and have been buying more of it. So nod off.
5% dividend.
It's
never going to get there again. They're not cutting that anytime soon. Average relationship in that bank is somewhere around 24 years.
Mine is 48 years. Literally 40, because I was there before it was really Fifth Third, when you had them coming together to make Fifth Third. But yeah, I am with Fifth Third literally since I'm a teenager. So,
Wow.
yeah, that and First,
Look at that.
I brought it up to you. First Financial Bancorp, which used to be the old Southwest Ohio. That is a bank that at some point I'm going to have to bend Tim's ear on, because this is a bank that's dressing itself up to get purchased. I think they are. They're strutting around right now. They're trying to be the bell.
Nearly all Fed policymakers see more appropriate hikes this year, says Powell. So a couple of things that we've said in the last 5-10 minutes. A Fed Market Committee will make a meeting by meeting. Great. The main issue is the policy firming needed to bring down to 2%. It makes sense to raise rates higher, but at a slower pace. I don't know what that means, but okay, maybe you're going to go up 25 in July, but you're going to signal that you might be raising in October. October could get bloody. Powell said a rate decision shouldn't be called a skip. He said part of the reasoning behind today's decision is that they don't know the full extent of the banking crisis. Today, the balance of risks moved closer to our destination, sufficiently restrictive stance. So this is a hawkish pause. There's no certainty of the agreement in the profession. And looking at core PCE over the last 6 months, there's been a lot of progress. We want to see core PCE moving down decisively. Once again, reminding you that inflation needs to be drowned. 5.6% Fed funds rate, up from 5.1 in the March meeting, Chris.
Yep.
So
PCE at 4.5, far above our target, not really, moving down. We want to see it moving down decisively. Yeah.
So now the question is, as we head into the end of the day, do we get that kind of January run where people just come in and say to hell with it, YOLO, and keep buying, or are we going to roll over and sell off? I'm going to be jumping over with Vaz right now for 3 o'clock. I don't know if you want to hop in as well. You absolutely can, but that is our next destination. Chris, this was fun. I made some money. I'll buy you a sandwich.
All right. I love it. All right, man. Always love talking to you. We will see you. See you guys.
Thanks. Have a great day.